Correlation is one of the most important yet often overlooked concepts in the Forex market. It refers to the relationship between two currency pairs and how they move in relation to one another. Understanding correlation not only helps you diversify your trades, but also allows you to manage risk and optimize your trading strategies effectively. In simple terms, correlation in Forex measures how two currency pairs behave relative to each other. If the pairs have a positive correlation, it means they tend to move in the same direction. For example, EUR USD and GBP USD often exhibit a positive correlation, meaning that if EUR USD rises, GBP USD is likely to rise as well. On the other hand, pairs with a negative correlation move in opposite directions. A classic example is USD JPY and EUR USD. When one goes up, the other tends to go down. Correlation is measured on a scale from 1 to +1. A correlation of +1 indicates that the currency pairs will always move in the same direction. A correlation of 1 means they will always move in opposite directions. A correlation close to 0 suggests there is little to no relationship between the pairs. This type of analysis is essential to understanding how your trades might interact with one another. Why is correlation important in Forex? Primarily because it helps you avoid unnecessary risk. Imagine opening two trades on pairs with a strong positive correlation, such as EUR USD and GBP USD. Rather than diversifying your portfolio, this actually doubles your risk. If the market moves against you, you could face losses on both trades. On the other hand, correlation can be used to hedge positions. For example, if you have a long position on EUR USD but are concerned about potential adverse movements, you could open a short position on a negatively correlated pair, such as USD CHF. This helps balance your risks and maintain controlled exposure to the market. There are several tools available to measure and analyze correlation between currency pairs, such as correlation tables provided by trading platforms. These tools show the degree of correlation between different pairs over specific time frames, such as a week, a month, or even a year. This allows you to make more informed decisions about how to structure your portfolio. It's important to note, however, that correlations are not static. They change over time due to factors like shifts in monetary policies, global economic events, and market volatility. Therefore, it's crucial to review correlations regularly and adapt to changing market conditions. In conclusion, correlation is a powerful tool for any Forex trader. It not only helps you understand how markets interact, but also enables you to diversify strategies, manage risks, and make smarter decisions. By learning how to use this concept effectively, you'll be one step closer to becoming a successful and disciplined trader.